Good evening, ladies and gentlemen. On behalf of Team Indusion, I would like to thank and welcome all the attendees and esteemed panelists for being a part of our most successful Talked After webinar series, Exponential Leadership. Today's subject, in the fifth edition of this vibrant series, we shall discuss navigating the vagaries of new normal for the wealth management industry. I'm your host, Vijay Vaishnav, co-founder of Indusion Consulting, a diversified premier search firm specialized in middle and senior level management talent across industries. This includes BFSI, ITES and global service delivery, diversified corporates, and digital and technology. My co-host for today is my colleague Shilpa Jain, having around 15 years of experience across wealth and asset management prior to joining us 11 years ago. She heads our wealth, asset, and consumer finance practice. Today, our discussion revolves around the challenges faced by the wealth management industry in view of the change in regulations and rising pandemic. Over the last 20 years, personal financial wealth has soared over past 2 decades, nearly tripling on a global basis from $80.5 trillion at the end of 1999 to $226.4 trillion at the end of 2019. Despite multiple crises, the growth of wealth has been immense, resulting into more wealth in more hands. In India, individual wealth grew by 9.62% in FY19 to 430 lakh crore. The major growth rate of 10.96 was seen in financial assets as compared to the physical assets, which grew by 7.59%. In the last 5 years, the HNI population in India has grown by 64.1%. The COVID-19 pandemic is bringing the world into uncharted waters. What else can we expect? The pertinent question is, how does the asset and wealth industry cope up with this new COVID-19 world? What are the immediate priorities? This industry excels at problem solving. We are now facing one of the most greatest challenges of our time in the increasing globalized world. Within the asset and wealth management industry, it is no longer business as usual. Asset managers and third-party service providers need to be well prepared. However, serving the changing needs of the wealthy is going to get very demanding, as there will be a paradigm shift in their needs and expectations. How is the wealth management industry adapting to the evolving needs? How strong a role will digitalization play? And how will one combat intensifying competition? While there are many challenges to be confronted, the eventual bottom line is that the industry, its workforce, its customers, the markets and economies will not only survive but thrive. Today, as part of our panel, we have invited leaders who have seen the sector growing over years, offering value-added products, sales and service driven by technology and innovation. Our panelists are not only CEOs or business heads, but they're also gurus of various facets of the ever-changing, evolving industry. The question to ponder amidst the crisis: how do we navigate the vagaries of new normal in the middle of the unprecedented crisis? I shall now hand over the baton to my colleague Shilpa Jain, who will introduce us to the esteemed panelists. Shilpa, over to you.
Thank you, Vijay, and a very good evening to all the panelists, and thank you for taking out time from a busy schedule to enrich us with your views. We would also like to extend a warm welcome to all our members who have logged in. Without wasting further time, I will now proceed to briefly introduce the panelists. I start with Soumya Rajan, who is the founder and CEO of Waterfield Advisors. As the founder of Waterfield Advisors, India's largest independent multifamily office and wealth advisory company, Soumya brings over 25 years of financial services experience. She started her career with ANZ Twinlays Bank, later Standard Chartered, and spent 17 years with the bank. Her last assignment was that of Managing Director and Head Private Bank at Stancy India. Since founding Waterfield, Soumya has advised several of India's leading business families on their global investments, including issues related to the succession and continuity of the family enterprise, corporate and family governance, business strategy, and philanthropy. The company presently advises assets to the extent of $3.5 billion US. Apart from being recognized amongst India's top 100 women in finance, Soumya also serves on the board of several non-profit organizations, including C-STEP and People. She's also a mentor for Aspire for her foundation, which is again a not-for-profit setup. Soumya's hobbies include music, travel, and interior design. My next panelist is Nitin Rao, who is the CEO of Incred Wealth. As an industry veteran for over 3 decades, Nitin has now been given the onerous task of replicating his success story at Incred Wealth with a special emphasis on maximizing customer satisfaction and shareholder value. Nitin has previously been at the helm of operations of HDFC Bank since 2000, wherein he led its private banking business to market leadership position. Nitin also had a brief stint as CEO with Reliance Wealth Management before joining Incred Wealth in 2019. His strong and dynamic leadership helped HDFC Bank to bag several awards and recognitions. Under his leadership, HDFC Bank won UTI CNBC TV 18 Financial Advisor Award for 5 times and Euromoney Best Private Bank Award for Mass Affluent segment consistently for over 5 years, alongside other accolades on different occasions. Nitin has done his MBA from Symbiosis Institute of Business Management and BE in Mechanical Engineering from College of Engineering. Nitin's interest lies in cooking, binge watching, practicing yoga, and meditation. He is an avid follower of Sadhguru. Our next panelist, who's also the moderator for this evening, is Anshu Kapoor. As head of Edelweiss's private wealth management business since 2010, Anshu has grown the business 15x over the last 7 years. That business has been internationally acclaimed and awarded as the best private bank in India by global publications like Global Finance, Asia Money, and Asian Private Banker. Anshu is also a part of the Edelweiss Managing Committee and a key member of the Edelweiss Technology Steering Committee that formulates the digital strategy of the group. Anshu's prior experiences include working with erstwhile Merrill Lynch, wherein he was instrumental in developing the business in India and overseas. He also worked in leadership positions with HSBC and ICICI Bank. Anshu is a CFA and a business management graduate from Delhi University. He's passionate about scaling up businesses, technology, and is an avid travel photographer. I now move on to my next panelist, Atul Singh, founder and CEO of Vagaries Wealth. As a veteran in the wealth management industry, Atul decided to capitalize on his expertise into incubating a new wealth firm in India, that's Vagaries Wealth, of which he is the founder and CEO. He has painstakingly handpicked talents from across domestic and international wealth management firms with client centricity at the core. He is successfully changing the landscape of how investment will be done in India across UHNI, HNI, and mass affluent segments. His experience transcends over 2 decades. Prior to founding Vagaries Wealth Management, he was the MD and CEO of Julius Baer, one of the largest private banking businesses in India. He also worked with Bose, Allen and Hamilton prior to joining erstwhile Merrill Lynch. Atul is an MBA from IIM Bangalore with a Director's Medal and a degree in Electrical Engineering from Birla Institute of Technology, Ranchi, with a Presidential Gold Medal. Atul's passion includes photography and understanding wines from regions across the world. Our next panelist is Vivek Banka, founder, Gold Teller, and ex-founder IIFL Altior, which recently got acquired by IIFL Wealth. With a career spanning over 2 decades in the financial services sector, Vivek has truly seen it all, from working in his family's stockbroking outfit to starting his own wealth management practice, taking care of BNP Paribas Wealth Management Initiative in Bangalore, building and growing IIFL's wealth management practice, and finally creating a world-class fintech platform, Altior Capital. Altior was subsequently acquired by IIFL Wealth in November 2018. Its proprietary platform allows extensive use of analytics on the client's entire net worth in a visually appealing interface. Vivek has now embarked on his entrepreneurial quest once again with the founding of Gold Teller, currently in stealth mode in the personal finance space. He is an avid tennis player, likes reading and playing video games. And last but not the least, our final panelist is Anirban Banerjee, Managing Partner and Head Human Resource, IIFL Wealth and Asset Management. Anirban's primary responsibility is to enhance the human capital quotient of IIFL Wealth and Asset Management. He has more than 16 years of experience in human resources across the wealth management and FMCG industry. He has played a pivotal role in building the talent pool from across domestic and international firms. His keen understanding of the business, despite being from a non-wealth management background, has gained him a lot of respect and recognition from the industry. In his words, he also looks for what he calls the warmth within, the drive which makes a person say, I can pull this off no matter what. Anirban was part of ITC Limited for 4 years prior to joining IIFL Wealth and Asset Management. At ITC, he handled the labor force at their largest cigarette plant. He received his post-graduation diploma from XLRI Jamshedpur and is an alumnus of St. Stephen's College, New Delhi. His hobbies include reading fiction, playing, and following tennis. Before we start, I want to share a few quick guidelines. For those who have logged in from the mobile device, You can swipe left or right to see the entire panel. There is a Q&A button at the bottom of the screen. You can start sharing your questions. Please direct your question to the respective panelists from whom you wish to get a response, and we will try to answer them towards the latter part of the webinar, time permitting. Thank you, and over to you, Anshu, to take over the discussions.
Thank you, Shilpa. Thank you, Vijay, and thank you, Team Indusion, for giving me this privilege and opportunity to grill my dear colleagues. It's indeed a privilege and an opportunity I'm not going to let go. So all of you, please, get ready. There are tough questions coming your way. And I think we will focus a lot more on the future than on the past, or, talking about the scenario and so on. And we will try and bring in fresh perspectives, because many of you may have attended some of these conferences, and we will try and be as practical as possible and try and at least, because all of us come with so many different experiences, try and bring some of the core experiences and the strengths out from each one of us. And that is my endeavor. Let me begin by asking Soumya, about, the reason we exist is for our clients. And I just wanted to get your perspective, Soumya, on whatever is going around and, the way the volatility has been over the last almost 2 years now. What are you seeing from a client perspective change, from their risk tolerance, from their return expectations, the way they interact with us, from the overall portfolio building or product selection? What are you seeing, and where is it headed?
So thank you first, Anshu, for the question, and thank you, Indusion, for having me on this discussion. I think what we're adapting to is first the new normal. I'd like to first set a little bit of context in terms of what is that new normal. And the new normal that we're seeing today is clearly this entire work from home culture that we now have from a business point of view. The fact that our clients are now engaging with us and interacting with us digitally as compared to what was always considered an extremely high touch kind of business. We have personal health and safety, which has become a very important piece of the new normal for both clients as well as employees. And I think we have also a society and citizens that are looking for a better world post-COVID than the world before. So if you were to look at keeping these at the back of our minds in terms of the context and what is that new normal, clearly the way in which we're going to adapt as wealth management firms is going to be a little different. If I come in specifically in terms of looking at what kind of investment patterns for clients, since Anshu, that was your specific question, I think when you look at constructing portfolios for clients, you always start fundamentally with what is that risk appetite of the client, what is the investment horizon, what is the asset allocation. And I think one of the things that you, as wealth managers and wealth advisors, we need to do is in some ways to stay true to that asset allocation. Many a time it's very easy for clients to say that, look, markets are going in a complete tailspin or otherwise. But what is important is that that principles of asset allocation were done for a particular reason. Now, it's our job and incumbent upon us to handhold the client during periods of extreme volatility, which is what we're seeing right now. And quite honestly, I think for all of us, this is the first time that this is an economic crisis which has been created because of a health crisis in the first instance. So unlike previous crises that we've seen, which have been largely financial markets driven, this is quite different. And we're also seeing that regulatory intervention has also been different to the extent that, or it may have actually been the same. They've just been pumping in large amounts of liquidity, whether they did that at GFC or whether they're doing it now. But the question is that the way in which regulators are pumping in money and creating this liquidity, I would also look at, should we be ensuring that our clients don't get into a situation where because of the liquidity, there's an asset bubble that's getting created in the future, and we're not really watching for that or holding the hands of our clients at that time, at this point of time. So I think asset allocation is important. Sticking to that asset allocation is important, but walking through this volatility with our clients in this phase is equally important, but not making them really deviate too much out of where they currently are. That would be my take at this point in time.
Right. Thank you, Soumya. And actually, I'll extend that question and let me ask Nitin. With all his years and decades of experience, and he's seen the banking world and the wealth management world very, very closely, dealt with countless number of clients. Nitin, my question, I'm just trying to extend this is, how does the industry become, transition from this provider of products to provider of portfolio? And client from buyers of products to buyers, or at least looking at the portfolio. I think, the industry and the client, in my opinion, are both equally responsible, for, just products being out there in the portfolio. So what can we do, just to make this transition? What is your opinion? You'll have to unmute yourself. Nitin, you're on mute.
Hi everyone, thanks for this opportunity. Thanks to Anshu and Indusion, and welcome to all the panelists. See, it's a difficult question, but the way I look at it, yes, you're right that I've gone through various cycles, but I started off my career at the bottom of markets where nothing was going wrong when the Harshad Mehta scam broke through. So that time also Sare Zameen pe the, and in a different way when the pandemic hit, Sare Zameen pe pahunch gaye. Okay, so the way I look at it, it's not too surprising because events keep coming at different points of times, and corrections have happened which have been extremely steep. To that, what I think Soumya said is perfect, that asset allocation is the model which has to be followed. But the question is, our industry has evolved around the product pushing strategy. So to that extent, when not everybody, but by nature, people will sell what is in demand. So when structures were being sold, everybody sold structures. When equity was being sold, everybody sold equities. And wherever asset allocation was done, life became easier. And wherever it has not been done, I think it's learnings for clients. So the only way to handle this is so clearly, because of the regulatory changes now, the impact of product pushing is becoming less and less as you go more towards trail models in most products. Most products are now carrying similar weightages. So even RMs in their selling practices are now coming more to selling the common products, and with advisory catching up, the concept of advice has also come in. But the way I look at it, these are opportunities for clients to understand asset allocation and how it will play out. And we just reinforce this as the corrections happen. We need to give them, I remember doing this with a client a long time back when the markets had tanked and he had RBI bonds and he was a big client from Jaipur, RBI bonds and equity. And the market had tanked some 30-40%. One had to convince him that stay the path, don't worry, and it'll all come back. And in 1.5 years, it came back to the level. And this guy was so thrilled, but he didn't realize that a market will also bounce back as the economy improves and as valuations come back. So I think it is, luckily for us, the regulatory regime is going more towards helping asset allocation. And I think the RMs will also mature. The other problem that I want to highlight is many of the RMs in this group, maybe over the last 7-8 years, have not seen the fall which we saw over 20 years. Over the last 20 years, we have seen these sharp falls. So I think it's a good learning for the RMs also. I don't think clients have panicked too much. I think clients have been stable through the process, have made strategies which are sensible. And I think it has only evolved as we go ahead. So I think we are going in the asset allocation direction, and product selection is becoming more and more important.
Right.
Just as a last point to highlight, I just think back that just about 2 months back, everybody was selling credit funds, and suddenly people are saying now you can go and try credit. So this is evolution of the way people interpret asset allocation and the needs. So I think the market is evolving.
Right. Thank you, Nitin. And I will come back to you on this point, and we will continue to dip into your decades of experience. I wanted to move on. I'm just continuing this thread, and I'm moving to Anirban. And my question to you is now, okay, there is an agreement that we need to move towards a different model from product to portfolio. But how do you convince the relationship manager or the financial advisor to see merit in that? You know, they are being conditioned, right? They've been conditioned over years to just go and talk about product one, product two, product three. So how do you make this shift? How do you reward them? And you know, how do you drive this momentum? Are you doing something about it?
Thanks, Anshu, for the question, and hello to all the panelists, and thank you to Indusion rather for getting me on this panel. Tough question, Anshu, and I'm speaking with a bunch of CEOs here who have been doing this for a long time. So, but see, the fact is, I think today, particularly over the last couple of years, I think relationship managers are starting to understand that there's no way out. Even the hardcore believers of product pushing, and when you meet them either in interviews or within the industry, are starting to come and say, hey, what do we really sell which has a commission? So first and foremost, there's no way out. Second is regulation every other day. Even the last one that came last week as well is kind of pushing you in that direction. The third is that the days of a banker going and selling a 1 crore AIF and then saying that, or maybe an insurance policy and then saying, this is what I've done for the month and I'm happy and to go, has been over for the last few years also. On top of it, every intervention that you are doing, every experience that you understand from people in the world outside to all the stalwarts in the industry, you kind of understand that until and unless you move in that direction faster, you will be the one who will be the last in the value chain. You're already seeing hardcore, large, big relationship managers who have been used to the previous model falling way back just in 6 months of a year like this year. So what we are doing, Anshu, is working a lot with external facilitators, internal trainers, a lot of case studies, a lot of examples, and at the same point in time, instilling the fact, which everybody knows, that over time, a trail-bearing product is more beneficial to you, is more beneficial to the client. And at the same point in time, every report that you read today, you are understanding that people are going to be paying for advice. So once you get all of these elements in place and convert it into a module and consistently communicate over and over in your team huddles, to your training programs, to his performance conversations, it's not actually a question that we are getting today too much. I think people have already imbibed it, honestly.
Thank you, Anirban. And I hope this transition is permanent and not, you know, for a short period of time till the time the markets pick up again and we lose our way. I hope all of us are committed and we do whatever it takes. And actually, I just want to stay with clients a little bit more. And I wanted to ask Vivek, why is there so much of friction when it comes to wealth management from a client experience perspective? You know, we see the whole financial system, banks and all, they report millions of transactions with zero error. Everything work fine, you know. So what is the problem? You know, this whole tech interface tends to break, reporting is not accurate. What is going on? Why?
Well, I think I'll possibly take a step back and give you a slight view that I have over the next 5-7 years. The industry will consolidate massively between, you know, 3 broad pillars. One, you'll have the distributors, then you'll have the advisors, and you'll have the manufacturers. And the fact of the matter is that, retentions are going down. This is something which can be seen visibly. And of course, the distribution part, I think, mostly would move online, because as the margins compress, people will be forced to use technology to, expand their reach. In terms of, the conflict between clients and advisors, I personally feel that there has not been too much of a spending on tech as it should have been. And there has been a large obsession of most institutions or wealth management firms, or even the robo advisors, if you ask me, over finding the next best fund to invest in, or the next best stock to invest in. Honestly, I don't think there is an answer to it, because if there was an answer, that answer would have been already there by now. What I think is lacking is people have not focused their tech on building processes around how an investment should be done, how asset allocation should be done. Again, asset allocation is a very subjective thing. The study by a CFA institute that, when we ask and make the risk questionnaire, people themselves do not know what their risk profile is, because it's one thing to actually answer a question that if markets fall 50%, I will buy more or hold on, but it actually doesn't work that way. Needless to say, what happens is, with all due respect to everyone, we try to make investment policies, etc., but that's not documented. And the fact, once it's not documented, the investor comes back and says, this is not something I had meant, or, XYZ. So it gives him enough reason to, break that policy. That is one. Second thing is in terms of reporting standards, since you asked me what is the friction, the reporting standards for the last, couple of decades that the wealth industry has been around, we have been following archaic models of reporting on Excel, etc. Excel is always something which is, of course, Excel is a very powerful tool, but the fact is that it can be manipulated, one, from a risk perspective. Second thing is, the minute you start putting more and more info on an Excel sheet, it becomes difficult to maneuver. And which is why I think there is a need for most wealth managers to, of course, it has started to happen in the last few quarters that I see, but there is an absolute need to improve on the reporting standards for most of the wealth managers that are around.
Thanks, Vivek, and we'll come back on the tech part of it also. I have some follow-up questions. I wanted to ask Atul. Now, you've seen the landscape, Atul, for a long time, and you have worked with multinationals who've tried to scale. What is it that a multinational or a foreign player can offer to Indian clients that is distinct, unique, or differentiated? And what are you trying to do in that space? You'll have to unmute.
Yeah, sorry. Yeah, thanks, Indusion, and thanks, Anshu. See, multinational companies have an advantage that that needs to be leveraged, but it's a limited advantage, right? So, having worked with a lot of foreign firms, I will talk about the disadvantage first. The disadvantage is that to build a successful business in India, you need to set a direction and then work on that direction or move on that direction for 10 years, right? It's a lot of hard and sweat and blood that goes in, but you have to work on a certain direction for 10 years. Without that, there is no success. And a lot of global firms, as you know, they really don't have appetite to work in a certain direction for 10 years, not because they don't really know that this is the right answer, but those organizations are made up of, the structure, and the organizational structure changes every other day, and there are multiple layers, and some layer gets changed, every month, and then everything changes on the ground, right? So they have fundamental inability to really move in one direction for several years, and without that, you have no real business on the ground. The other challenge is also understanding the needs of the client and aligning your business to those needs, right? So, the India business is not the same as Swiss business. It's not the same as Singapore business. because of nothing else. I mean, the clients are the same, but they're just in a different life cycle of their journeys, right? I mean, India is fully 100% first generation entrepreneurial market, or entrepreneurs having money, whereas Europe is third generation, and Singapore and US somewhere in between. So so those two factors, foreign firms being unable to align their business to the Indian needs, and not being able to really hold on a certain direction for 10 years, are fundamental disadvantages. The advantages are that they obviously have capital, right? I mean, that capital provides, if thought properly, the capital does provide the longevity for the business. It does provide ability to invest in the business, and it provides the brand that needs to be protected and provides comfort. See, private banking is a trust business, right? I mean, when you really talk to client and ask them to give the keys of their kingdom to you and make a promise that I will be here for, multiple generations, you need to really establish that trust. And a lot of global firms, because of their longevity, exude that trust, right? So those are the positives, and we spoke about negatives. So from my perspective, a successful business can be built if you really harness the positives, but also account for the negatives and control the negatives, right? So in my experience, at least, the work that we are trying to do is create the right sort of middle path where you're backed with global capital, so that and don't get me wrong, and there was, I think we were debating with some other people a few days ago, and the question was, what's the entry barrier in wealth management business? And anybody can really start a wealth management business. And it is true when you want to get 5 people around a table, get on the phone and start calling clients. But if you really want to build the right platform and the tech and the right capabilities and the right coverage before you really make the first call to the client, you need a lot of capital to really invest. And all of this this change of direction that we spoke about, moving to advisory, fundamentally means that there is no silver bullet. You will only make money over a longer period of time. But what does that mean? That means that you need ability to really sustain the business for a longer period of time and fund and support the business. So the capital is important. And so at least sort of our attempt has been that, look, if you get access to that capital, get that support, get the brand, but retain the entrepreneurial nature and an ability to really move in a certain direction for 10 years. Otherwise, you can't really build the business. So it's not a straight answer of multinationals versus locals. I think it is the right combination of the two that potentially has a higher chance of success.
Right, Atul. And yeah, I do agree that there's so many global best practices that we can all imbibe and import into India. And I wish you the best in what you're trying. And like you said, it's not easy. It will take time. But yes, it will be incredible to see a global player creating scale in this industry. It will be. And you used a very good term called capabilities. So I'm going to latch on to that term, and I'm going to come to Nitin. Nitin, now, again, dipping into your past and now what you're trying to build. So the question of scale, how will we build scale? What capabilities that are needed to be developed by the industry generically? Or if there's anything that you are trying to throw in the mix at Incred, the kind of work that you're doing. So banks obviously, have created immense scale. But when you look at the wealth management industry, we are still small, market penetration, number of clients penetrated, cities, and so on. So how do you think about this? Is this something that you're trying to solve? You're on mute. Again, you've gone on mute. Yes, now.
Yeah, sorry. See, having seen the evolution into where the industry has come now, I am so there are a few changes we are doing in the way we are evolving our business. I think the days of pure wealth management are over. I think now it has to be a like Vivek rightly said, it's a combination of distribution, manufacturing, and advisory, which are the pillars. And I think that if I have to see wealth management thrive, it has to be combination of distribution and management of the funds, or advisory and management of the funds. Unfortunately, the regulation has made it slightly difficult to merge the two. But management of funds is clearly an important part that is coming in. And I don't see, and the way I look at life is, if I'm recommending a company for investment which requires high return on capital and high return on net worth, there is no way that we should build a company which doesn't give those parameters. So that is one part of the story, that capabilities have to be shown and demonstrated through management of funds. Also, I think since we have quite a large international platform of bankers in our setup, including on the fund management, we are extensively going to leverage on international fund management capabilities into some of the products that we will get in, be it credit products, be it long short kind of products, or be it market products, or maybe investment banking or wholesale debt markets. So those capabilities definitely will make a difference into what the RMs are doing. Third is we are a fintech by nature, right? Because that's our parent business. So clearly tech will play an important role in whatever we create for creating the type of scale. But our belief is just tech will not help. It has to be hybrid models. So that is the one part of the story. And of course, part of the scale will have to come from acquisitions, be it RMs, be it setups in different entities. And of course, the other part of the new paradigm, I think Anirban was mentioning it, is the cost to income dynamics have changed totally. And that will have to be adjusted as we build it. So to that extent, what we will have to build, at least because we are a slightly newer entity vis-a-vis most others, is a different paradigm.
Thank you so much, Nitin, for this. I just wanted to get a different perspective also to what you responded. Soumya, I don't think you have any plan to manufacture.
No plan to manufacture.
And I don't believe you'd think like a fintech.
Yes and no.
Okay. Why don't we get the perspective on manufacturing and advice, and how do you see it, and why will it work for you?
I think the way I look at it is that in India, we've demonstrated how distribution businesses have been built at scale. I think the challenge, or the way I look at it in terms of what we're trying to do at Waterfield, is can you build an advisory business at scale? And I think the challenge always has been that from this whole fees point of view, you've now suddenly got to ask clients for fees in an advisory business as compared to a distribution business where you were getting fees from the product manufacturer. And I have a slightly different view, maybe from Nitin, that I think technology is going to play a very big role in terms of that ability to scale. And when I say technology, I'm not looking at it just in the context of client onboarding or client servicing, or just using it for a client experience point of view. I think the difference is really going to be in terms of what it can do at the back end, which Vivek touched upon, in terms of using technology, in terms of analytics, and actually driving the investment decisions. Ideally, what you want to be able to do over a period of time is, because a firm like ours does not manufacture any products, I want to be able to source the best product wherever it is for a client portfolio, which is completely curated based on their risk appetite, their investment horizon, and it shouldn't be specific on geography. So technology is going to drive that in terms of, my own sense is that clients are going to look for a much more personalized and curated experience going forward. We cannot paint everybody with the same brush. The challenge for wealth managers is going to be able to try and deliver a very personalized, curated experience for a client in a very low cost manner, which means that the only way you're really going to be able to do that is where technology comes into various facets of the way in which you run your business. So whether it's in analytics for investment products, client onboarding, you can build scale really through technology only, particularly if you're looking at a very geographically dispersed kind of environment like India. We've got so many different cities. The kind of wealth that we're going to see created over the next 5 years, 10 years is going to be exponential. And it's not going to be in the Bombays and Delhis and Chennais of this world. It's going to be in tier 2, tier 3, tier 4. How are you going to reach out to all these people? Because we cannot be throwing bodies and saying that RMs have to be in each of these locations. The only way we're going to be able to harness this and be able to bring services and solutions to clients is really harnessing everything that tech has to offer to us, and not just looking at it from a very pigeonholed view of it's only a client onboarding experience. No, much more than that, much more than that.
Thank you, Soumya. And you've raised some important points, and I wanted to come to Anirban for that. The role of the RM in future. So how do you see, today RM is the carrier of advice, RM represents a brand, carries the relationship, knows the client intimately, and obviously there is access to the organization and the platform and so on. But how do you see the transition happening, the role of the RM of the future?
I actually was talking to a few experts a few days back, and my view is that the RM will actually become more important than what he is already in the future. Million things, right? I mean, we all speak of technology and we all come and say that technology is going to be important for scale and getting things at the back end. But at the same point in time, everybody comes up and says that we need to hyper customize, hyper personalize. And unfortunately or fortunately, whatever examples we've seen so far, it's, as Nitin said, it's going to be hybrid because there is no technology solution, at least today, which can hyper customize for the type of clients that we are talking about. So which means that for the port of call, the RM becomes very important. Also, a lot of organizations in the last 4 to 5 years ended up building tremendous number of touch points with the clients. You had an investment counselor, you had 5 different bosses, you had the service RM, you had the asset manager, you had the product expert going down. And with the way the retentions are going, it's possible over time that the number of touch points with the client actually reduce. And those touch points are fulfilled by technology. And which means that you will go back at some stage to the client with RM being the face of the relationship. So my personal opinion is that the RM will become more important. Obviously, yes, firms will be far more selective. The RMs will take more time to break even. It is going to be a question of scale. Every banker earlier, when I joined the industry, if you had a 50 crore book, you were supposed to be a great RM. Today, somebody has a 1,000 crore book and you are asking questions as to when do you think you will really start contributing. So I think things are changing, but the RM will remain pivotal, if not more important as time comes by.
So if I may also ask you a follow-on question, Anirban. So what do you think about the compensation models? And are you seeing a shift?
It's like putting myself on a spot of bother, but see, I think fixed compensation will remain to be under severe stress and pressure. It's not because it's 2020 or it was 2008. I think from the last 12 years that I've witnessed the industry, again, a few more things have happened. When you were hiring a top of the line banker in 2008, you were paying the guy 30 lakhs, 35 lakhs, 40 lakhs, best case 50 lakhs. Today, when you want to hire a team leader who can come with a lot of people, it's become multiples of that number. So I think fixed pay will remain under severe stress. over the course of at least the next year to 2 years. But I think the variable pay, particularly on trail income or advisory income or discretionary income that you were to talk about on discretionary portfolios, will see significant jump up. And I also see the bigger RMs becoming bigger as time goes by. Today, for instance, we are already seeing the engagement levels with the clients is actually higher than when we were actually physically meeting the clients. Today, you call up a banker, he doesn't really have the time because he's always on one call or the other. And it's very easy to move between calls. It's just switching off one and opening the other window. So I think the engagement levels have actually improved. Going forward, I think that's the way to be. We also have to be patient with clients. So maybe revenues will take some time coming. But yeah, to put it in a nutshell, I think fixed costs will remain difficult to increase far more, but variables will see a resurgence in that sense.
Thank you, Anirban, for being so candid with this response. And on this whole hybrid model, Vivek, I wanted to invite your thoughts. You've been a banker, you've seen different models, Vivek, and you've now moved to technology. So how, from your lens, are you seeing this? What will be the future of this hybrid model be like?
Well, I agree with the fact that there will be a hybrid model. Only technology is not the solution, but in the hybrid, the role of tech would be 90-95%. If I answer maybe a little bit of your earlier question in terms of the role of the RM, I think the role of the RM, the role of the RM will surely become more important. But what I think will change drastically is today, if a RM can handle 30-40 relationships, I think that should go up to 100-200 because of technology. So if I were to give an example, today the RM has to go through the portfolios, see where there is a need for a certain product or blah, 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 and then basically give a recommendation. I think all these recommendations, at least 80-90% of them should happen through technology, and the RM would be needed primarily for two reasons. One is, attend to the outlier advice, which is there. So let's say if you, through your model, you get 10 funds, and then one fund is not doing well, but you have confidence in the fund manager to revert to the mean. In that case, you override technology and basically take a human view on that. But I am very confident that over the next 5 to 10 years, the RM will become more important, but the number of RMs will reduce in the industry. And this has happened even commercials. I've seen in the broking industry, in my family broking outfit in the mid 90s, the brokerages were north of 1-2%, and this is the time when there was the whatever that where you have to basically cry on the floor and shout out model. Yeah, that's the term, shout out model. And you see where brokerages have come now, and with discount brokerages, I think brokerages will come down further. So if I take a leap from that, I think the wealth management or personal finance industry eventually will also tread that path. Maybe not to that extent, because broking is kind of a commodity. Here, the RM would be needed, but as I said, he would be needed more from an outlying advice perspective. And secondly, of course, he would be needed to cajole the investors during bad times, because as I said, and I have seen many investors, because at Altior also, we were only consolidating, it's very good to make investment policies, asset allocation during good times. And it's a very different world when you actually have to follow that. And thankfully in this market crash, the market has turned around very sharply, but I'm very sure of a lot of investors who were, staring down the barrel and were actually looking at exiting only to get back again at lower levels. So my belief, to summarize, is the hybrid model is the way to go, but in the hybrid model, tech would be the lion's share, and the human element would be a lower share. I speak not only for the HNI or the UHNI segment, I speak for the general wealth management industry as a whole. Of course, on the UHNI side, for multiple reasons, I think investors need a human face to go to, whether it's for an ego massage, or I mean, there could be multiple reasons, but people need someone to basically fall back upon.
Thank you. It's very insightful. I'm going to shift track a little bit and maybe talk a little bit about product or solutions. And Atul, if I may ask you, we've been hearing about this whole internationalization of portfolios or diversification and so on. Is it real? And if it is, how big can it be? And what do we need to do to get there?
So Anshu, I believe that every Indian family needs to globalize in their attitude, perspective, as well as their investments. Because, above a certain threshold, and that threshold is actually not very high. That threshold is not 100 crores or 500 crores. That threshold is actually, even I would say probably even at a 50 lakh, 1 crore, 2 crore level. The need for an Indian investor to behave like global investor is there. It's real. And both from and I think, we make a big deal of diversification for risk, which is currency depreciation. But I think even from accessing opportunities, the diversification has to be there. I mean, there is a need for risk, but return as well. And also from lifestyle perspective, I mean, most of the affluent Indian families their lifestyles are changing. I mean, the kids are going abroad for education. The travel is mostly abroad. You want to access global healthcare. You want to have alternate citizenship, etc. And for all of that, or properties, for all of that, you need a pool of global capital that is managed differently. So there is no question in my mind that there is a need, and that need is not at the highest level of assets, but actually across the board. Now, what is the big challenge in my view is lack of, not lack of access, but lack of advice. That, let's say if you want to put $500,000 in offshore portfolios or a platform, good quality advice is not available, right? And again, you can get product pushing, but are there people who will actually manage it as a real portfolio in a fully asset allocated way? And build robust, balanced portfolios? I think that approach is not there. And as you know, I've run a couple of large private banks, that were global, and we all thought, the world thought that the Standard Chartered and Barclays and Merrill and Morgan and these banks will actually serve that need, but they have not really been able to. And the challenge has been that all the global private banks would say to Indian client that, hey, we'll serve you provided you have $3, $4, $5 million. And if you go to retail banks offshore, you get pushed pretty bad, nasty products. So, you really in the middle, you really don't have credible advice. So in my view, the challenge or the bottleneck is of advice. Not the demand side is absolutely there. So it's a supply side issue, and the issue is again not of access, but of high quality advice.
Sorry, I was muted. Thank you, Atul. Thanks a lot for that. Yes, I completely agree with you, that in our mindset, in our portfolios, investments, we need to be very global in our approach. I just want to stick to the product.
One of the things that, I talk to clients about is, we live in India. We are building a business in India, right? I mean, our life is in India, and we have chosen that to be here. But as an investor, you do have a choice to actually choose very differently, right? I mean, we say that India has had the harshest of lockdowns by far, and we have had the thinnest of fiscal stimulus. And the reason is that, look, we don't have money. But as an investor, and US is exactly the opposite. I mean, there the money is just coming from all directions, and both the monetary and physical. So as an investor, I do have a choice of holding the hand of, quote unquote, sort of the stronger guy, right? Who has the ability to really spend and control the economic damage and fuel a little bit of recovery. As an investor, I have the choice. I mean, as a person living in India, I don't have that choice. I can't just get up and go and move to America. But as an investor, I do have. So one should exercise that choice.
Yes, definitely. Thank you, Atul. I'm going to continue on the path on products and solutions. So Nitin, you mentioned that you're thinking like a fintech. And what does it mean from a product or a offering perspective? What does it look like?
When I meant, um, I think I'm on. So when I meant fintech, I wanted to highlight that the backbone of a fintech is software and technology. So in our InCred Finance FinTech, there are 100 engineers developing technological solutions, which are not really heard of in normal kind of NBFCs. So clearly, from a FinTech perspective, the technology platforms and what we develop over a 2-year time frame with high quality software engineers will be something different. Already right now, I think technology platforms have evolved where today you're much better placed than maybe a few years back. Also, so fintech is essentially one part is technology, one part is product innovation, right? And the way I look at the product, they will be different in different segments. We are also trying to target the entire spectrum, though mass affluent would be in a separate entity in time. But in the HNI and UHNI space, um, a lot of my career has been built with a mindset which has been focused within India without looking too much at diversification abroad and all that. And now suddenly I have a lot of inputs coming in from people who are globally oriented, they're global Indians. So the discussions that I have on products are a scale which is entirely different. So so clearly product evolution, and I now believe after having been there for some time that the way asset allocation and the way investment strategy works vis-a-vis the conventional mindset that we have built over 15 years is slightly different, little more aggressive, little more dynamic. So the scope for evolving products from an international mindset into product evolution in India, both for domestic products, structured products is the most easy to explain, but beyond that, into agile products when the rates are going up internationally, if you can put a debt product out for diversification, or um, so anything that can be evolved is an opportunity that we can give for global Indians. So the way I look at fintech is using tech aggressively to build platforms. I think there Soumya was also highlighting the importance of how technology can be used. So suppose an RM goes on the field, he meets a customer, he clicks a button and he gets to know what is the recommendation to give, or he wants to talk to the research person on the field. It just is an instantaneous click. So servicing becomes instantaneous. That is the fintech part. The product evolution is agility to ensure that products constantly evolve in line with the mindsets. It will be different for different segments, but will definitely evolve in each segment the way I would look at it from my setup.
Right. Thank you, Nitin. And I want to still continue with this thought. And Soumya, you've been a big proponent of asset allocation. Now, the confusion in my mind always has been India is should be a simple market, single currency. You don't have complexity of multiple currencies, 2 or 3 big asset classes. Okay, leave aside the real estate and the physical asset classes. It's just equities and fixed income. So, there's so much volatility still involved. Now, purely from your lens, what product categories or what needs of customers from a product perspective need to be filled in, just to make it a little bit more wholesome and something that would, stand the test of time?
I think we have to here recognize a little, Anshu, on I think what are the changing face of client needs. Clearly, again, the way forward is going to be greater transparency, lower cost of investments. So if I'm looking and as Waterfield is a capital allocator at the end of the day, I think the shift is coming in areas like more passive investments, more index investing. We don't see enough products in that space. We also don't see enough products on sustainability and ESG. I've spoken about it in a couple of forums because I do think that in this post-COVID world, there is going to be a demand from multiple stakeholders that is going to push sustainable investments. So I think we need to start looking at that. I think very early days for India still. But nevertheless, I see passive investments as being something that I would like more fund managers and product manufacturers to look at. I would certainly want more sustainable investments to come my way. And I also think this whole space around alternative investments, around private equity, around venture, and certainly for the segment that I operate in, which is in the greater than $10 million of financial assets. There you're seeing clearly the intent of moving more towards alternative assets in terms of client portfolios. So earlier that was, in most families, maybe 3 to 5%. That's now moving up to almost 10 or 15%. If you look at global averages, it's actually around 35 to 40%. So the question is that how can we also build that ecosystem with domestic capital is also something I think that we, as wealth managers, we will also start needing to develop expertise on as well. So those would be my broad points in terms of where I see some of the asset allocation moving going forward.
Right. Thank you, Soumya. And there's one question actually I forgot to ask on, the growth of the industry, the human capital. And actually, I would like to invite everyone's views on this, and starting with Anirban, as to how does the supply of talent come? We all, there was this big numbers that Vijay kind of narrated in terms of the unexplored potential of this industry. Where is the supply, and what do we do?
It's tough. Traditionally, I think this supply has ended up coming from the retail banks. It's in some senses also comes from some of the insurance houses, some of the corporate bankers, some merchant bankers, and some of us tried going to campuses and getting people on board. Today, unfortunately, at least over the last couple of years or so, that has pretty much dried up. So even though when I said that, fixed cost will remain stressed, the fact of the matter is that when you go to hire somebody, the first conversation point is, okay, how much can you pay? So it is definitely difficult. There is no doubt about it. Going forward, I also think that the willingness of the people to enter this industry when they know it's not a quick buck game itself is going to be challenged. So it will then come back to all of us to develop newer modes of developing talent. Examples could be from other verticals. Examples could be from, again, going back to some business schools. Examples could be from curated courses that are happening all around the world today. But there is a silver lining, right? I mean, we are only talking about relationship managers, but the fact of the matter is what this COVID entire pandemic has taught us is today, if you were to go and hire an analyst, he necessarily doesn't need to be in Bombay or Delhi or Bangalore for that matter. You are suddenly more receptive to a resume coming from Indore or Khandwa or, Bhatinda. So I think there's a new way of looking at things that will emerge. At the same point in time, from a relationship manager category, given that you will want to select the best, you will keep going back to your older sources. At the same point in time, try and groom a newer talent in different verticals and move them to relationship managers as a role. Today, most of us, as we are speaking, when we go to a team leader or head of business and say that, I've got this fresh guy who is willing to come in and learn the tricks of the trade. The first fear of the guy is, okay, how much time will he take to shape up? And the second fear is, what if he quits after that? So I think the answer will be a mix of all of this, picking up the best from some of the business schools or some CFA courses or so on and so forth, putting them in other roles before they get interested into the relationship manager spectrum and we see the talent there, as well as grooming some of your non-so-called relationship managers into this role going forward. But it's going to remain a challenge. Anshu, you're on mute.
Thank you for your insights. This is a question for everyone. If anyone else has a view on this question, please by all means go ahead. Atul, you wanted to say something?
Yeah, I think, see, the supply obviously cannot be created overnight, because we always have said that it's an apprenticeship business, right? I mean, you need to really be in the trade to have learned the tricks of the trade. But there is a different perspective that can be put. Now, our definition of RM also is convoluted. Anshu, exactly as you said, that we always believed RM to be, one-man army, right? I mean, he right from client acquisition to relationship management to advice. I mean, the guy has to be financial wizard to really deliver advice. The guy has to be extremely detail oriented so that he doesn't miss, because he's the prime service arm for the firm as well. To the client, and should be very empathetic and completely sort of relationship oriented. So those are you're actually looking for a Superman or Superwoman. So I think one possible answer is, again, it needs to be proven, but one possible answer is that you need to disaggregate this whole bundle that you look for in an RM and say that, hey, can I really separate the advice component from the service component and keep the client acquisition / relationship management component separately, because all three require different set of skills. And then, as Soumya said, as Nitin said, as Vivek said, then bring technology to really scale up those functions and complement the RM with those functions. So, servicing, a large part of service fulfillment can be taken up if technology is used in the right manner. If technology is used in a better manner, then a lot of the advice component can be used or backfilled with technology as well. And that would, to some extent, leave the relationship and understanding the complexity of the discussion that you're having with the client, which requires, empathy and emotional quotient for the RM. So if you really sort of disaggregated that, I think the addressable market for a successful RM can be larger and can be really extended. But like we have discussed, it again goes back to the hybrid model, and this is sort of one way of putting the technology and people together by complementing each other. So that's one possible answer, though not that I have a proven sort of model on that, but that's something that we're thinking actively on.
I have a small thought on this. Is that leaf out of this is from the Azim Premji Foundation. Now earlier 5-7 years back, they were basically setting up an university for teachers, and a lot of people asked Mr. Premji that why invest a lot in teachers when with all your might you can invest in training students itself. So his view was that one teacher can help me train 500,000 students. So my thought is, I'm not sure how much it is doable regulatory wise, but today you've got the investor education spend, which mutual funds, and CSR spend, which mutual funds and wealth management companies have to do. I think why not have some bit of this spend also towards catering to education of in colleges, etc. The certified financial planning industry had come up 10-15 years back, but unfortunately, if you see the number of CFPs today are hardly, it's completely died down. So I'm saying there has to be unfortunately, these questions are asked during bad times. In good times, we generally do not ask these questions, and then it is you don't care much about how much whether the RM is good or bad, because a tiding rise lifts everyone. So that's the problem I feel. So just my 2 bits on this.
Well, thank you so much. Nitin, you want to say something?
Yeah, see, the traditional way for a big guy would be to kind of train, that is obvious. But the way I would look at it as a small entity is to groom the next level of leaders, because we are kind of a little senior in that space, but the next level, which is emerging, can kind of play a big role in building teams with the right profile. And I see that happening. So if we give the entrepreneurship ability to the team leads to kind of pick up young talent and groom them. And I see a lot of young talent who come up today and very young, maybe 3 years, 5 years in the industry. And you ask them, what do you want to do? They are very focused. They want to do UHNW advisory as a long-term goal, which I have not heard maybe 10 years back or 15 years back. So there is a pool of people coming up. How they will be groomed is the challenge. And I do think that identifying the right level of leaders who are building this business can play a big role in building the next level of talent, and then it'll multiply.
Yes, completely agree with you. I think getting the leadership right is the key, because then you can groom, I mean, like Vivek said, get the teachers trained first.
No, just to add here, I think the leadership will always be, people will always be there. We have to just mold them to lead into developing people.
Yeah. Soumya, you have anything to add to this?
Not really. I think it's been very well kind of captured and articulated by everybody. This is very much, I think, a little bit of what Atul said. It's an apprenticeship kind of business. I mean, all of us, I think, learned by virtue of seeing role models and people who have built similar businesses, relationships. So in that sense, how do we create that? Though I do think it is probably the single biggest challenge that we face is really on human capital that we all have to tackle. Of course, as a company, we are very focused on women. And I actually think they make fabulous careers in wealth management. For us, we've actually looked at women coming back into the workforce as actually a great pool which can be tapped into because they've had a career break. They've also gone through the paces of working in financial services in the past, and then can come back and resume their careers in this business. So fairly big believer that that could be a very good pool for us going forward.
Very insightful. Very, very insightful. Thank you, Soumya. I am conscious of time, so I'm going to invite Vijay and Shilpa if we have any questions that we could take.
Vijay's got the questions.
Yes, thanks, Anshu. And thanks, everyone, for all the insights. Now, our normal course is basically picking up questions which have been sent by a lot of panelists. What we're doing now, there are a few questions which are addressed to all the panelists. And hence, we'll pick up 2-3 questions and not addressing this time to a specific panelist out here. So the first question is, which I guess I can start with Anshu, and everybody can give their views, because a lot of investors also who have joined on this, apart from the ones who are aspiring candidates or candidates or the fraternity which you deal with. The first question is that the markets currently seems to be going in contrary to what is actually happening on the street, not just in India, but globally. Given the scenario, how does one stay capital protected?
Well, how do you stay capital protected is not to take any risk, first of all. So the safest possible form is to invest in any kind of government or government-owned entities, then go to a bank in a bank deposit, and that is the ladder you have. So if you want to be protected, go for safety. And there are many other solutions available. And if all of us get into details, I think it'll get a little tiring for everyone. But whoever wants more information, happy to, ping me or ping any one of us. We can send some information out.
That's fair, Anshu. And I think the sub question to that is that how, given that you see markets or the product suite, typically the goalpost changes very frequently, because of external conditions, global scenario, regulatory framework. So given that, Nitin just mentioned an example right in the beginning about somebody who took a government bond and when markets shot up. So given that goalposts change frequently, how does one actually arrive to a midterm or a long-term solution?
Right. So maybe I can go first, and then, other colleagues can join in. Actually, I have come to learn the hard way after doing this for so many years, is that volatility is very real. And, the traditional theories of long only, stay invested, do not hold so good. I mean, did any one of us imagine oil will be trading below zero? It'll be negative. That is not financial theory, right? So I think every 5-6 years, financial theories are being challenged, and the amount of volatility we are seeing as investors it is insane. It can drive anyone completely against their goals. While asset allocation and everything is important, but at the same time, it is important to be completely on top of where the asset allocation is and what active changes need to be made to portfolio. So I am a firm believer now. I also used to believe in this long only invest now, great valuations, companies, all of that. But I think I've also come to a point that two things. One is fixed income is fixed income. Do not take credit risk. Second is figure out low volatility solutions in your portfolio. Three, be active. You can invest through passive funds and all. You can invest through low cost solutions, but you've got to be very active in assessing how the portfolio is going. So I'm just going to pause here if any other colleagues have points of view here.
Atul, your take on that?
No, I think it's similar to Anshu, but I would just add sort of a level, not going active, but I think I would add the dimension of rebalancing. So asset allocation is good to have as a goalpost, but I think at the same time refreshing the thinking, the assumptions that go in building that asset allocation also has to be done on a regular basis, right? So for example, yes, we had an asset allocation before COVID. But I can tell you, every single assumption that you took about the market, about your own life, has changed, right? So now, what is prudent is to actually go and rejig the portfolio with the new set of assumptions, right? I mean, there is a very clear thesis of which industries are going to really sustain less economic damage, which industries are or which companies are going to recover faster. So, your portfolio now has to be in sync with some of those realities. And this is just one event. I think somebody mentioned that it's not like, the world is going to be without events. I mean, these events will keep coming in. And if these events don't come, our role actually becomes limited. If the world is a very peaceful, sort of straight line, then we are not needed to really handhold the client. So I think it is not going active necessarily, but I think with an asset allocation and having a component of rebalancing on a regular basis and retesting those assumptions, even though you may retest and not change anything, but that process is important.
Got it. Nitin, your thoughts on that? Yeah, please.
Again, I go back to the start of my career where the markets were between 3,000 and 6,000 on the Sensex. And every time it went to 6,000, we would say, Upar jayega 12,000 ko, and it would come back to 3,000. So people lost all that they made. So from then on, and I saw 3 cycles of that. So from then on, my philosophy has always been exit. So it is important to do all strategies, asset allocation, rebalancing, but either define the needs, either define the life goals, but at some point of time, on a regular basis, exit has to be done and moved into safe assets, and then that money should be forgotten. That is so therefore I believe exit over a long-term time frame of maybe 15, 20 years has to be put in investor strategies as a regular basis beyond rebalancing.
Absolutely. Anything, Soumya, you want to add?
I think, Vijay, you made the comment when you started the webinar that wealth has actually tripled over the last 20 years. In that sense, I think if I looked at just GFC, you had $10 trillion which was wiped out in 2008. That came right back by 2010, and wealth was at its highest at close to around 133 trillion at that point in time. So my sense would be is that wealth, interestingly, is quite resilient in a 20-year time frame or in a longer time frame. So I think some of these knocks that we get in markets or volatility balancing. An actual example, gold, for instance, was never in client portfolios 6 or 8 months ago. And now suddenly it is featuring in client portfolios. So you have done a tactical rebalancing almost. which was not there in the past. So I think
I think we lost your audio again, Soumya. I think, Soumya, we can't hear you. Let's fix this audio thing and probably move on to the another topic, which is Anirban. If I can start with you, with technology evolving both on service and product curation, how tough you think it's going to be for RMs to acquire and retain the clients, more so retain than acquire?
It's definitely, the job is becoming tougher. There is obviously more time invested with the client today than what it used to be for the same amount of assets or revenues. But if I were to just put it in perspective, about 10 to 12 years ago, the largest wealth manager in a non-bank wealth manager in India would have been at about 10,000 or 11,000 crores of assets under management. Today, you're talking about closer to 200,000 crores. And the thing is thus that every relationship manager is also handling larger wallet share per client. And which also means that he or she is able to provide very, very differentiated solutions, including asset allocation. He's doing a lot, many more things, whether it is ability to lend, whether it is ability to provide advice, whether it is ability to manufacture a solution for him, whether it is to provide a will or a trust or an estate planning service. And I think over time, clients are also thus getting far more ingrained with the firm. I spoke a little while ago about the fact that the number of people who are touching base with a particular client from a firm is also the highest that we've ever seen. So I think firms are trying harder. They are being more agile, more responsive, and RMs are becoming more empathetic. It obviously requires more effort, more understanding, more knowledge, but I think that's the way it's going to continue.
Any other comments on this? Soumya, you want to continue earlier point? I think your audio had gone off.
No, I think I will just pause at this point. Thank you, Vijay.
Another point I think which has come up by a lot of people saying that how do you see valuations of of wealth tech headed with all the buzz around it vis-a-vis conventional wealth platforms? Given the fact that you need to protect both investor and clients and business interest, right? You reach a stage of a dichotomy out here. Maybe I can start with Vivek on this. How do you see the valuation game catching up? I mean, we've been hearing a lot of buzz about wealth tech being valued in a different multiples compared to a conventional wealth management firm. How do you see that? Where do you see the intersection point?
Well, I cannot comment on what they're valued on at this point in time, but of course, any valuation of any firm is typically the combination in my mind of two elements. One is the product, the tech product that someone creates, and second part is the business. Of course, needless to say, the business is something I think people are extrapolating too much, that a wealth tech company can completely kill the market, which is not true. This quote is not attributed to me, but I think it is very relevant. People think that a wealth tech firm can do what an Amazon did. It is not true, because of the primary fact that in something like an Amazon, as soon as the product is sold, the service ends. And in a fintech firm, it's actually the opposite. The minute the product is sold, the service starts. And the fact is that today, the kind of margins that have eroded in this industry, I am not sure whether the valuations will sustain to the extent that we can see right now. I have done a lot of work on robo-advisory firms, both in India and the US, and most of them are bleeding, and I cannot fathom from where remotely in future would they turn profitable, with more products. Because the problem is that if it's not like an Amazon where you can sell more products and get more money out of the customer. Here, the problem is the industry as a whole, the margins are coming down. And then you get one such incident of a black swan event the industry takes 3-4 steps back. So my sense is that there is unfounded exuberance in a lot of the valuations that we see. And specifically, I see, as I told you, that most of the fintech, wealth tech companies are very, very obsessed with, very vertically obsessed with trying to, cater to the next, big thing. In fact, one thing which I would like to say, most of the wealth tech platforms are investment planners and not financial planners. And that is where the problem lies, because, they ask you 3 questions, 4 questions, and then you're given your risk profile, and then you're asked to invest. I don't think that is sustainable. And if you see in the US also, the large 2 players, Betterment and Wealthfront, they have largely seen the good cycle. I think even this cycle was very short. So one bad cycle, and I think, you'll know who's you'll know who's what. So I think to answer your question and summarize, I think the valuations that we see are irrational to a large extent, and valuations will grow and these companies will grow, but I think reversion to mean will happen, both in terms of volume and, more importantly, people will realize profit making in this industry is not as easy as it looks like.
Got it. Anybody would want to add? Yeah, Atul, please.
So, one way to think about is that segmentation. So if you really think about a retail segment or a bottom of the pyramid where, somebody is doing 5,000 rupee SIP in mutual funds, etc. It's not about how much money they have, but there is correlation between how much money they have to the complexity of managing that their financial life. So I think the fintechs have been quite successful and will potentially be far more successful in actually taking that part of the market fairly easily, because that, you need to really manage cost to serve and client acquisition cost, and technology can help you do that. And the level of complexity that you need in interacting with the client is much lower. But like we have, all of us have repeated that, higher than a particular threshold, the complexity of the discussion becomes so much that all of it to be put in technology, then the technology itself, the customer experience itself will become so complex and it will lose its meaning, because you were trying to simplify the customer experience with technology. So, that's like Vivek, we've also studied several models around the world, and there is no successful model on technology-led wealth management alone above a certain threshold. At the retail level, including Betterment and Wealthfront have been successful, but doing again, $10,000, $20,000, $50,000 asset allocation as well. So it's not just product access; there is advice embedded in that as well, but for a very low complexity interaction. So that's one way to think about that. In Indian context, it is very hard to compete with Paytms and Phone Pay and a lot of these players, including Amazon. All of them will come into wealth management, and all of them will compete, the game on technology, and they will capture a very large part of the overall pie, which is anyway retail. But I think, all of us on the screen, at least, potentially are not after that pie. So for us, the only sort of game is that, look, we actually cannot fight the technology battle alone. I mean, head to head, you can't fight it with Paytm. So that's why you got to bring the RM into the mix and say, hey, let me enable the RM with technology so that he is my differentiator, because, others cannot really, Amazon cannot really scale up with RMs and kill us. So that's the only defense we have, and I think above a certain threshold, that defense is valid.
Understand? Yes, Nitin.
I just want to add, we have seen a lot of wealth tech firms, and most of them are bleeding. Okay, so while I think Vivek also did mention, but very good platforms, very good developments, but bleeding. The problem that is happening is the revenue model is not factored in. It's free advice and all those things. So really then one doesn't see how to make money in that, right? So I think if the model changes a little bit to a model which is revenue driven for the development of technology which happens, valuations will really soar. Otherwise, it's a challenge, wealth tech valuations.
Absolutely. Now, I'll just pick up a very, last point for a quick comment from everyone because we're running out of time. Uh, though obviously I've known, all our panelists and this is something which I think a lot of people, your own colleagues, organization, people would want to know. Uh, how sustainable is this engagement, which is virtual today? How sustainable it can be for, you think 3 months, 6 months. Look, clients, businesses in India are almost always driven on the framework of personalized engagement, especially in segments like wealth management where you're dealing with HNI and ultra HNI. So there are a lot of RMs and a lot of people have told us that they have a fear of being out of sight and out of mind. What will be your advice to them? We can start with maybe Anshu.
I think parts of the organization, Vijay, is likely to move, are likely to move to work from home. But I don't think permanently you can be work from home or be, impersonal in that nature, because when we meet, we generate what I call social capital, and which is very, very, very important for any organization. So the way, I think the way, at least I can tell you, the way my thinking has changed is I have realized that my enterprise teams don't need to come to office every day, and people don't necessarily need to travel from Borivali or Dahisar or all the far out places that they come to just to punch in trades or punch in orders. So from that perspective, it will become decentralized and it will eventually have a cost impact, as in we will become more efficient. That is one. And other parts of the organization, maybe 30% people could work from home, but on a rostering basis so that everyone comes together or at defined intervals. But the concept of the office could change. And it will also need a mind shift, because mind space shift, because we are used to dedicated desks. We are used to dedicated offices, and there is no need for it anymore. So I think that also could, shift a little bit in the future. And this whole decentralization of work, eventually, I believe we will be able to pass down the cost benefit to our customers. And it's a very important event that has happened in this industry, because we have carried friction in our, in our back office, in our front office. We have just been lazy about this, and we've just said, "Oh, here's a problem. Throw one human at it, and it'll get solved." Like earlier, we were saying, "Chalo Excel sheet pe kar dete hain." So I think it has forced us, and it is a good step going forward that we will become efficient, and I hope that we pass on that efficiency to our customers.
Ban, you will have some take on this one.
Yeah, Vijay, I think what's going to happen, as Anshu said, is you're going to have a lot of these common enterprise-oriented functions where you're suddenly going to ask them, "Hey, do I really need to call him to office? Do I really need to pay the rent for him in this office?" And thus, I think over time, some of these roles might move to working out of satellite offices, ancillary offices, or homes. But technology still needs to come in. Today, Amazon, while it is working from home for a lot of its people, I'm just picking on Vivek's example, has systems where the video camera needs to be on all the time. And if there's somebody behind you who passes, after beyond 4 times, the system automatically shuts down. So, issues around confidentiality of data, on issues around, yes, a lot of us are still working on physical signatures, digitization versus digitalization, and so on and so forth will remain. From the RM standpoint, which I have a slightly different view. I think the younger RMs, the older RMs, though all have gotten on the screens. The fact is, any city that opened up, the relationship manager was quickly called to the client's office or the client's home. So I think from the RM standpoint, we'll again continue to do this till the time there's no choice. We will do some levels of engagement where there's for example, there could be a video eKYC or something like that to open accounts. But from a relationship standpoint, I do foresee that the RM will end up meeting the client going forward as well, as and when this subsides. From an organization standpoint, though, the questions on culture, the questions on hiring without physically meeting the person, the question on moving somebody to a leadership position without actually seeing the guy in action on the office floor, are things that we really don't know how to do. Our offices have been traditionally been based on the factories that came up. So factories came up in cities, workers moved to the cities, gotten into a shop floor. The way it designed was that a supervisor should be able to see everybody, and slowly it became open offices. But we've just taken that from a factory standpoint. But how this will impact, culture, cascading the value systems of an organization, I don't think anybody has the answers yet.
We say that.
Neither do I.
We wait for the time to say that. Anybody wants to add anything on this topic? Yeah, Soumya, you can see.
I think the comment I'd like to make is that where, at least what we've seen is where we have had a social engagement or an interaction with a client in the past, it's been much easier to transition that during lockdown in terms of actually working with that client. I think the challenge actually has been on prospecting and signing up new clients where you've never met them before. And you're trying to do it virtually and trying to onboard the client when you've only met them virtually. I think that's still very much a challenge. So my own sense is that if you're looking to grow new business, then that physical, kind of interaction in terms of meeting the client in person is extremely important, at least for the segment that we're operating in at this moment.
Absolutely. And with that, I completely agree with you, Soumya. I'm happy to come down to meet any of you all with all the mask, whatever required, to ensure that that goes on. Fantastic. So I thank you so much, all of you all, for taking this time out. Shilpa, I will hand it over to you for vote of thanks to all our panelists and attendees. Shilpa.
Thank you, Vijay. Many thanks for the insightful and enlightening session. Big thank you to our esteemed panelists and audience for participating. Have a great weekend and stay safe. Thank you.
Thank you.
Thank you.
Bye. Great weekend.